Hi everyone, I welcome you all on my YouTube channel. Before any further, I just wanted to let you know this is my page, LinkedIn page, and you can come here and see all the interview related question and answer of accounts payable, US sales and use tax, and US direct tax also. And also you can watch for record to report, financial analyst, and order to cash profile. So I have posted many articles, many posts I have made. You can go through all the question and answer, but for now we are going to discuss junior accounting interview question with answers. So we are going to discuss this, and this post I have uh, posted on my LinkedIn account 8 months back. First question is, define the accrual basis of accounting and explain its significance. So as we all know that in accounting there are two bases of accounting. One is accrual and then another is cash basis. So we must have read that cash basis is obsolete, and we only use for now accrual basis of accounting in while recording the transactions. So the accrual basis of accounting recognizes revenue when it is earned and expense when they are incurred, regardless of cash is exchanged. It is significant in financial reporting because it provides a more accurate depiction of a business company financial performance and financial position compared to the cash basis of accounting, which only records transaction when cash changes hands. So I will explain you why it happens that we go for accrual basis of accounting and not cash basis of accounting. In cash basis there is a very big loophole that if you receive the cash, then only you can record the transaction. But as we know that in business it is not possible to do all the transaction in for the instance and we can give the cash, because many of the product we purchase on a credit basis and many of the goods we sell to the customer on credit. So it is not possible to do the transaction on cash basis of accounting and record in our books in cash basis. So for that reason we go for accrual basis, because it gives us the clear picture of our financial position. We tend to know what is our income, what is our expense. So this is the reason why we go for accrual basis. Now we have second question, explain the concept of materiality in financial reporting and its impact on financial statement. Materiality refers to a significance or importance, as the word says material. So that is significance or importance and of an item, event, error in financial reporting. Information is considered material if its omission or misstatement could influence the decision of the users of the financial statement. Materiality guides accountant and auditors in determining what information should be disclosed in financial statement. Material items are typically reported separately in financial statement to ensure that users are aware of the significance. So basically what happens, what this question is trying to ask you and what you should answer to this question, materiality is when a transaction that can affect our business and the investor to invest in a company, that is material. If you have not received some amount from a debtor, like that is negligible amount and that can be recovered, that doesn't needs to be disclosed. But for that also we make provision for bad debts, so that is a different concept. But materiality is when there is a need to inform all the users of the financial statement that this transaction can affect our financial position or financial statement of the company. So you should be mindful enough to disclose that information to the users to be aware of the significance. Now we have third question. What are the four basic financial statements that must be prepared by corporations? So this question is very famous and it is a good question, but when you start giving the interview when you are fresher, you do not remember this on your tip of the tongue. So it's better to understand these four elements and also remember these four elements. So first is income statement, that we also call as profit and loss statement. Then we have balance sheet, statement of financial position, then statement of cash flow, then statement of shareholders equity, or that can also be called as change in equity. And if you remember these 4 points, that is very good, but you should be aware of a little bit about each aspect, like income statement, why we prepare income statement. That answer should also be in your, like, while you give interview, so that makes a good impression on the interviewer, that yeah, she or he knows better, so that can create a good impact. So you should be prepared enough to answer that question. Now we have fourth question. How are intangible assets such as patent and trademark typically accounted for on the balance sheet? So we will give it a read to this. Intangible assets such as patent and trademark are recorded on balance sheet at historical cost or fair value, whichever is more reliable, determinable. They are typically amortized for finite lived intangibles or tested for indefinite lived intangibles over useful lives. The amortization expense or impairment loss is recognized in its income statement. So as we know that intangible assets such as trademark, patent, copyright, it doesn't have the market, like we cannot get the value from the market, so we record on its historical value. So this is the case in case of intangible assets. Now we have a question. What is the purpose of income statement and how it is different from balance sheet? So as I have told you, that interviewer will be so happy when you tell him that I know these four statement we prepare and I know why we prepare. So that is a very good impression to give. Now we will read about the income statement or profit and loss statement. Provide a summary of a company revenue, expense and net income over a specific period. Example, fiscal quarter or year. It shows how much profit loss company has generated during that period. In contrast, the balance sheet provides a snapshot of company's financial position at specific time, its assets, liability and shareholder equity. So both the statement we prepare has different roles. Like in income statement, we basically record all the income and expense over the year which a company has accrued, and in balance sheet we show our assets and liability and what are the funds we have raised from our shareholders. So that has been shown in the balance sheet. Now we have sixth question, that is our last question. Explain the difference between cash flow statement and cash flow forecast. So for this you should always read a company's cash flow and its meaning, so that will be helpful for you. A cash flow statement reports a company actual cash flow, inflow and outflow over a specific period, categorizing them in operating, investing and financing activities. It provides a historical record of cash movements. A cash forecast, on the other hand, is a projection of an expected future cash flows based on anticipated income and expense. It is forward looking and helps in financial planning. So one is for financial planning and one is our financial record. So both are very different. So this is the question which can be asked to a fresher, and there can be more questions can be added to this, like some journal entry or something, which I have already made video on my channel, so you can go through with that also. And if you have any query, any questions, please write it in the comment box. Also you can reach out to me and I will surely answer that questions. Thank you.